where does that money go?
If they don't spend all of their levy, then it goes back into the general fund. If they don't spend all their grant money, which they do, then that would have to carry over because grant money has to be spent on certain things.
Because it sounded like in our last health meeting that Cindy said that her overage on her budget was gonna be more than covered for.
They have so much COVID money coming from that they're not going to spend all their levy
Right.
this year and probably next
And
year.
how that would usually work is we as a county would accept the money, which therefore amends their budget. And then any additional expenses will come out of that new revenue source that had come from the state and the feds. So.
Any more questions? Hearing, we're moving to number.
Nope, I need a motion, please.
I make a motion to transfer $5,964.84 from the contingency fund to the, where is it going?
IT outlay,
IT department outlay.
if
As long as you can.
Public funds are not available.
public health funds are not.
I'll second that.
Motion by Tom, seconded by Jeff. Any other comments? Hearing none. All those in favor signify by saying aye. Opposed? Now we're going to number 7. Take it.
Couple new faces, I think, but my name is Amber Dursey with CLA. I've been working with the county for a number of years, so here to do the audit presentation. If there's any questions as I go, chime in, let me know. I'm going to start with the bound financial report. There's a couple stapled documents in the back, but I'm going to start on page 1 of the financial statements. This is our independent auditor's report. This is kind of the complete summary of our audit in audit terms, I guess you'd say. So we've audited the accompanying financial statements of the governmental activities, business type activities, each major fund, and the remaining aggregate remaining fund information of Kewaunee County as of and for the year ended December 31st, 2020. Management is responsible for the preparation and fair presentation of these financial statements. We are responsible for issuing an audit opinion on the financial statements. On the top of page 2, you'll see the opinion, and we say that in our opinion, the financial statements referred to above present fairly in all material respects the respective financial position of the county as of and for the year ended December 31st, 2020. That is a clean, unmodified opinion, the best opinion we can give from an audit perspective. There is an emphasis of matter right below that. That is signifying the new accounting standard that was adopted by the county for the 2020 year. And that is GASB statement number 84. That is pulling out fiduciary type activities out of the general fund and other various funds that the county would have and putting those in a custodial fund. That's really your clerk of courts, register of deeds, and those types of funds that are fees set by the state and thus turned over to the state on a monthly basis. So real estate transfer fees, those types of things. That's what makes that up. Then I'm going to go to page 5. So page 5 through 7 are the government-wide financial statements. On page 5, in the asset section, just one item that I want to draw attention to is the net pension asset. That is the county's proportionate share in the Wisconsin retirement system. We talk about this every year. It is now in an asset position compared to a liability position in the prior year. And that's based off market returns and things that they do at the state level. But you will see it's what that means is it's overfunded for actually December 31st, 2019, because it is a year back as they do an actuarial valuation. That is a non-cash item. We do restrict that in the fund and the net position of the county.
What would that surplus become years down the road? I mean, if that continues to be a surplus, it can't be touched.
It can't be touched. And it's going to fluctuate. In the back of the financial statements, there's an RSI schedule that will show you the last, I believe there's 7 or 8 years in there now. That'll show you, and it fluctuates approximately between 96 and 104% funded. And that's due to the Wisconsin retirement system fluctuating contributions, fluctuating market expectations and things like that. So unfortunately, it's just a number that has to go in here that draws attention because it sticks out and people are like, we don't have a pension.
The most important part to know, at least from an employee standpoint, is WRS is fully funded,
Yes.
has been fully funded, will remain
Yes.
fully funded until the legislature goes on a large bender and decides not to put in their dollars, which won't
100%.
happen.
Correct,
It's the best retirement system in the country.
correct.
And it's in the black, that's all good.
Yes. And when it's in the red, it's
It's
not
really
by far,
not.
it's really not, it's not by much, so. Then on page 8, this is where page 8 and through, through 11 is your fund financials. So this is really the operations of the county. Draw attention to a couple funds here. So that I'm gonna start with human services, and work myself to the left. Your human services fund balance at the end of December 31st, 2020 was a deficit of about 325,000. And that sounds scary, but compared to December 31st, 2019, that was 1.2 million as of a deficit. So their fund balance changed by about 890,000 in 2020, which is a right direction compared to where we've gone. So there's still some things that are working out, but you've taken some good steps there. So that's a positive. County roads, the ending fund balance as of December 31st, 2020 was just shy of $2 million. And obviously that's for road work and set aside for that purpose. The general fund has a total fund balance of about just shy of 8.2 million in total. Your unassigned fund balance, which is really what we use to benchmark and what we like to provide advice on, is your policy is between 25 and 35% is what you want your policy to be, where you want your fund balance to be. And that's on page 55, but that is of the actual 2020 general fund expenditures. And that comes out to about 2.7 to 3.8%, or 2.7 to 3.8 million is where your policy wants you to be. You are currently at just shy of $6 million. Where that was years ago, not that long ago, compared to this, is great. So some very good decisions have been made, some good trends in the right direction, very healthy fund balance. So again, you should be at about 2.7 to 3.8, you're about 6. That allows you some flexibility, it allows you to make some decisions and grow and things like that. So Paul does a great job providing documents and budget to actual reports and things to departments to make decisions, and they're able to make better decisions on a more timely basis. So that has a big part in that. So
The other part that we had done is, the other reason why the general fund was higher than what we would normally do if our range was because we, in the past, had the landfill and we had human services in negative fund balances, in deficits. And so while the general fund was a little bit higher, that was to, in some ways, cover those deficits from a larger standpoint.
correct. And the non-spendable, you can see that there, the non-spendable, your advances to other funds are about 220,000 of that. There was a point in time where that was
1.5 million.
just alone. So great news, good financial condition there. So page 10, this is your revenues and expenditures from a operational standpoint. The general fund, as I mentioned, human services increased about 890,000. Your general fund up about 415. There is a full detailed budget to actual by the function level and department level on pages 64 to 69 that you can reference. There's a few things that kind of made that happen. Your sales tax had a good year. That was over budget by about 200,000. And some other various revenue lines, and then some underspending on some expenditure lines, part maybe due to COVID and some things like that, maybe some programs not running. But you can see that full detail. But again, about 415,000 added to your fund balance in the general fund. Then I'm going to go to the solid waste and highway and internal service funds on page 15. So your proprietary funds. Your net position in highway, you have about 3.6 million in net investment in capital assets, about 328,000 restricted And that is the net pension asset, so that is that amount. The unrestricted fund net position is about 2.3 million in highway. And that kind of, people will say, well, what does that tell me? So I always like to go to page 18, the cash flow. So highways cash flow, they generated cash from operations of about 474,000. And then they had cash flows from from capital and financing activities of about 317,000, coming to a net change in cash of about just shy of 200,000. What we like to look at is from operations, are they able to purchase capital items and pay off any debt should they have any? There is no debt in highway at this point. So are they able to generate enough cash to provide and add capital assets, equipment, things like that? Versus kind of digging into your levy and eating into cash over time. So as long as they can kind of manage that machinery cost pool, that really kind of comes back to this as well, which overall they've done a decent job of over the last number of years. So, but that's been a long way coming too.
So Paul, maybe I can ask you this. So if we're looking at a need for a highway shop, how would that get financed? Would this be a part of that monthly payment on the debt, or do we just go to a whole new thing?
Typically, internal service funds aren't designed to pay for multi-million-dollar buildings.
Correct.
So
that would just be for new equipment acquisitions.
yes, that
Yeah.
replaces the equipment they have, keeps them up to date.
Typically, if you're gonna build a new highway, most will go on the levy.
But you usually think county buildings are a levy responsibility. The equipment to run your operations is
Or personnel,
or personnel is a proprietary fund responsibility.
because that was gonna be my question down the road about the jail as well. You know, our overall health, I don't want to get ahead of you here, but if our overall health is fiscally sounding good, that we should be able to do some of these large jobs, if you will, and borrow that kind of debt. I mean,
Yes.
we're talking 20 million for a jail, and I don't know how much for a county shop, but
Yes, the answer is yes.
so, thank you.
Then let's go to, I'm gonna kind of skip these books get so big, so bear with me for a second. I'm gonna go to your internal service funds, page 80.
80.
80. There is a summary of the total of the two of them up on the same highway page, but I want to go individually. So page 80 and 81 has the health and dental broke out. So your net position in the health self-insurance fund was 266,725, and your dental is about 208,000. The health insurance had an operating loss of about 46,000. And dental had an operating income of just over 15,000. So not real bad years, but kind of stayed status quo year over year. Obviously, this can fluctuate significantly depending on claims and things like that. 2020, we obviously had COVID, but at the same point, there were a lot of non-elective type things. There were a lot of non-major things. So what we always just mention is just make sure that you're monitoring this in your premiums with your claims and things like that, which has gotten a lot better. I think, a few years ago, 5-6 years ago, it was a lot more volatile and it would swing one way to the other very quickly. But just continue to manage that and monitor it year over year. You can see the cash flow on page 82. Again, that cash flow doesn't tell you as good of a picture because it's an internal service fund. It's you're trying to charge departments, charge premiums to pay claim costs. You're not purchasing equipment or paying debt or anything like that. So that is what it is. Page 84. So as part of the audit, when we come in, not only does the county receive over $750,000 in federal funds, so we do a federal compliance audit, but we also review internal controls of the general every day, not just the program specific. And that is this report here on page 84. This is our independent auditor's report on internal control over financial reporting. And as part of that, we don't issue an opinion on internal control, but we are required to disclose any issues that we would have. So You can see that there are no findings for from a financial statement perspective. So no concerns there and no compliance issues from the financial statement issue. We do, obviously, during the course, we will provide any verbal recommendations that we see fit, but nothing major that would be required to be disclosed. Then on page 87, this is our independent auditors report on compliance for each major federal and state program. So as I mentioned, you receive over the $750,000 in federal funding. As part of that, we have a risk-based approach that we have to select programs. We're required to select certain programs every 3 years and test those. And if there's any new programs, we are required to test those if they meet the certain threshold. So we did have a couple major programs this year, and those are on here, page 101. So we tested the medical assistance cluster. So your food stamp programs with income maintenance and with CLTS programs and other various Medicaid-based programs. And then we tested a significant number of state programs as well, and that details everything on the bottom of page 101. So as part of that testing, we test controls, we test for compliance, and we did have a couple comments here. We had 3 findings to disclose. We have financial reporting for federal and state awards. That means that we prepared the federal single audit that begins on page 90 and goes through 96, I believe it's 98. So it starts on page 90, goes through 98. We prepared that financial document with the numbers from the county and with Paul's assistance in accumulating all of the grant information from all of the departments. Then the second finding was the uniform grant guidance implementation, and that's something that has been ongoing and a work in process for the county. And that really talks about documenting policies and procedures and written procedures really is what that is in regards to. The third finding is in regards to the Wisconsin Medicaid cost compliance report. Every year, the Human Services Department files a report with the state. And it's called WIMPR, but it's the Wisconsin Medicaid cost report that they file. And then usually the county will receive some funding back on that, but the state determines the amount. And we just had some issues with the documentation tied to the report. The documentation's there. It's just a matter of when it's saved and when the report is submitted, and there might be some differences. So we've worked through that. I think Paul has reached out to them, and they've kind of made some changes. It's the same finding we had a few years ago, but the documentation is much enhanced from a few years ago. But we had not tested that program in the last 2 years because that's on a cycle base, so that's why that is new.
Yeah, they are miles ahead of where they were last time this one came up. Last time, they essentially reinvented the wheel every time they filed a report. But they have a reminder of where everything comes from. This time is a matter of getting documentation didn't quite match up with it. So that is a much better result than it was 2016, 17.
Yeah, 16, yeah. That's part of the bad problem, or that's the bad problem of it is we're not required to test that program every year, and we do revisit it, and so that's why there's some time lag there on patient. Any questions on the bound document?
Could you go to page 41? That's dead.
Yes.
Not that there's questions, but more of a,
Nope. And to your question, to your point, so you talked about the levy and what's available to the, the financial condition. The legal margin on new debt is a good benchmark because you can see what the value of the county is, and you're required to not exceed 5% of that value. And so the county has room to essentially borrow approximately $83 million. Obviously you don't want to recommend that, but
yeah,
you want to stay within a certain percentage, but that is the calculation and what you have available should something happen that you would have to, but that is your total outstanding general obligation debt at the end of December 31st, 2020 was approximately $9.7 million.
so from a debt standpoint, we'll call it 10%. And for counties, and please correct me if I'm wrong, depending on what it is, you don't see a lot of them going over 50% unless it's a huge, because you don't, in case something huge happens, you don't want to have no debt capacity available. But to answer the bigger question, do we have adequate debt capacity to be doing what could be upcoming projects? Yes, I believe so. But I wanted you to see that.
And a lot of times what you look at too there is where's your other debt gonna fall off? So if you go back, actually right above it, you can see what your debt payments are over the next number of years. And a lot of times, you know, if our debt's gonna fall off, we wanna kind of keep your levy at that same point, so then you can kind of add on the new debt at that point. And that's where, to Scott's point, a lot of counties, they're not exceeding, the ones that struggle with this debt are small municipalities.
Right.
Because their values are significantly lower. But from a county perspective, you have a lot
And
more
that's-
flexibility.
And that's why their percentages at times are much higher. You
Right.
can see a city that will have.
And that's
debt
the
of
relationship I'm
50.
trying to understand the county's perspective versus
Right.
the cities,
And-
because they are totally.
Yeah,
different.
a
And
city
they are, but
perspective, you could
the
see
county
something
is so
at
much
1%.
bigger, so that's the reason why
Yeah.
a debt percentage of a city is gonna be so much higher than it would for a county.
As well as if you build a mile of city street, it's not gonna cost you the same as it's going to for a county road that asphalt versus cement versus all the sewer and everything else. that goes with it.
Yeah.
Just costs more.
Yeah, some cities you'll see as high as, some get as high as 90% of their debt capacity.
Right.
They're-
Which is
they're
not
right up
what I would
against-
say.
No, they're right up against the limit because they don't have value and then they can't, you know, they kind of get strapped from a levy perspective and those are the ones who kind of
Hard to
really
recover.
struggle. So,
And she had already talked to you about on page 55 where your general fund balance policy is, which is 2.7 to 3.8 million. So we're flush with cash, we're relatively low on debt. So from a financial standpoint, I believe we're very strong.
And if human services continues the way they're headed, we'll be in a good position. to have a quick fix.
yeah, these meetings are a lot easier than it was 6
But they were
ago.
about 6 years ago. Yeah.
It
Yeah,
was,
we don't have a highway department in deficit. We don't
No.
have a human services department in deficit.
so
We don't have a
nice.
landfill in
Oh.
deficit.
You
Yes.
got a pile of IOUs just falling on the table.
It was, and it was always, it was a struggle sometimes.
I'm sorry.
No, that's okay, that's great. Normally I don't go into that, but that was a good piggyback off of your question. The other item is, so there's a 2-page staple document. This is the county's corrective action plan for those findings. And that's based off of conversations with Paul and things that, conversations with the department on what's been in process to be changed and things like that. And then you're required to report on your prior year findings as well and what the status of those are, so. And then the other staple document is our governance communication. So this is what we're required to provide to make to the governance, to the county board and so forth. So kind of summarizes things again I mentioned of what we audited. The county policies talks about the new GASB statement number 84, and then it talks about the accounting estimates. So there are a few accounting estimates within the bound financial statements that are included. And those include accumulated sick leave, the self-insurance, in the IBNR for the self-insurance, the depreciable life of the capital assets, the fair value of investments, net pension asset and liability, and the corresponding deferred inflows and outflows, and the other post-employment benefits, and the related deferred inflows and outflows as well. So those are all estimates within the financial statements. Going to the bottom of the page, we have no difficulties completing the audit. Great, Paul's great to work with. It's kind of nice to come in and do a true audit. Sometimes we go places they're not necessarily a true audit, so.
As
we'll
opposed to
keep
the
it.
old days.
Yes,
Yeah.
it's a little bit. So it's weird being out of here in 4 days. So I'm not gonna complain though. Thank you. Uncorrected misstatements, there were none, and no disagreements with management. The rest of that document kind of summarizes a few other technical things, and then the back part of that is management, management's representation, taking responsibility for the financial statements.
one item that I'll touch with is again, the one that has the audit findings. So for those of you that may see, okay, we have the same thing, we have two of our three are the same thing from 19 as they were in 20. Well, that is true. But the other part that I would go with is that we are continuing to work on these things. And I'm not sure if I can ask this or not, but we continue to, if we wanted to try to solve these right away, we could do that. But that would mean a lot more money and to get the documentation and the procedures and everything. Yet we can do this over time. We're continuing to address this. It's not an issue for me. If it was a huge issue, I would believe that the auditor would be saying that this is a major issue. Is that a fair way to say that or not? I don't want to put
Yeah.
words in your
Me-
mouth.
I could say the first one, to do that here, we need more staff, and I'm not sure cost benefit makes sense. The
Yeah.
second one is slow and steady. There was 0 things written down when I started here. That one we're chipping away at, that'll take a little bit of time. The third one was much improved, and a benefit that really isn't in there is one person did that before, and now because of documentation and everything else, not only we have it written down, we have a built-in backup because it's through looking at it. So that is miles ahead. And that one has that added benefit of not only having the consistency of the documentation, but now a built-in backup. And I will say when I took over payroll, it come back here, and that kept me awake. So that's a big report for human services, and not having the procedure written down was a major item. And now being to the point where, yes, it's working out well, but we need to do better documentation. That's a huge step forward. So that one will get taken care of this next year. I do not expect that to be next year.
Yeah, and I think the biggest thing for the county in terms of what I would look at here is I remember a time when we came in here and there were 8, 9, 10 findings in here with really no plan, no vision to correct them. They kind of were the same ones year over year. I think what you can do now is, should a state or federal agency come in and say, hey, we want to review your findings with you, or we need a response to them, which is common. You have a response, you have a plan, you have a vision in what's happening. And I think that's the best thing, because I can tell you, we have clients who we give findings to, and it's not saying something's broken. It's just, hey, this is something we're required to disclose and required to report on once we identify it. But as long as you have a corrective action plan, and that's really where the corrective action plan comes into play and why it's important, and then what your follow-up is. So now if you all of a sudden have 8, 9 findings and it's the same ones in the corrective action plan and in the prior audit findings, then they're gonna come back and they're gonna say, hey, we got a problem. But if you can continuously work to improve that, and like what Paul said, in terms of where you're at and what you have, I think this is pretty minor, and I think you're going in the right direction.
And I think that's the only reason why I brought it up, is because if you were to look at it and see that, well, this is a finding from years past, that I didn't want the committee to believe that we're not addressing the finding. It's just from a time and resources standpoint, we're continuing to work on it. But from a time and resources standpoint, if you wanted it done right away, the cost would be much larger. We can continue to do this, continue to make progress over time, address the issues, and therefore not have to expend the additional resources to make sure that we have that finding. I just didn't want the committee to think that the finding's there and we're ignoring it, which is not the case.
Questions or otherwise, as always, Paul and Scott have our contact information. Feel free to reach out anytime, any questions or concerns. And as you go through this, if you have anything additional, or as you continue through new items coming in 2021 and 2022. Thank you.
Thank you. Let me go next.
Yeah.
Okay. So the next one is just an update on the the Gills campground. So I know that Supervisor Rom had asked before, and actually I had gotten a call from John Price over at Bank of Luxembourg, and Cody and Haley are looking to continue to make improvements on the campground. And so they're looking to do a new mortgage for more money, so that way they can use the value of the land to get a larger loan to make more improvements. And we're still, and Jeff is on vacation, but we still need to verify whether the county needs to make a decision to, what's the right word? To take second position on what would be a new mortgage. In our previous contract, we had said that we would do that anyways, but we want to make sure from a legal standpoint that we're following what needs to be done. I do not see any financial issues here. If we did, we would bring them forward to you. I'm not asking for any type of action right now. If there is action, we'll bring it at the first available time. But I think this is good news that they're continuing to want to make continuous investments into the property and make improvements. So
Do you have any timeline and what the type of improvements are?
I believe what they're wanting to do is they've been doing some of the buildings, but they're also wanting to get sites ready so that way they can have campers and RVs come in. So there you go.
Explain to me, because I don't understand, what does that secondary position mean in terms of?
I will leave that to someone much wiser than I.
If they default, the bank gets their money first, we get our second. If there's not enough left over, the bank gets all theirs, we get some of it.
And as you recall, we said we'd be willing to do that?
This one's a little different. The reason Jeff filed a mortgage, I don't really have a mortgage, but part of the deal was we'll sell it to you for 60,000, even though it's worth more, but we expect the development on it. We didn't want to turn around and sell it. So by placing a mortgage, that prevents them from selling it without us saying, us giving our okay. So
So,
since we have a mortgage on there and they want to refinance, the bank wants to make sure they have first position. So we just have to go through that.
We're giving up our first position on that 60,000. That's the long and short of it.
We never really had first position on because they were the bank. We've always had second. But when they refinance, if we wouldn't, they'd be in second, which means they
The bank wouldn't want that.
they wouldn't want to give them an additional.
but our reason for doing that was really to prevent them from reselling. it.
From
Yes.
flipping it, because we sold it for the 30 acres at $60,000 is a good price. And then they could, it's not going to work. We're now going to sell it and sell it at a profit. That wasn't the
Got it.
reason why we sold it at that price.
Makes sense.
If, like I said, no action right now, but wanted the community to be updated. If it's okay, Mr. Chair, I'll go on to number 9, which is the health plan.
Go ahead.
Okay. Right now, you just have some general information. In September, we'll have Horton consultants, our insurance consultants, come in and talk about premiums and plans, possible changes to plans. So what you had in the packet was first, basically what our current premium and benefit package is for employees. That second page, or that second part, is just kind of comparison to some other counties that are clients with Horton, what their premiums are for single and family. We are currently estimating a 15% increase in premiums. And part of that has to do with large claimants. Large claimants have been killing us. They were 57% of our spend last year, which is roughly only 10 to 12 people. So to possibly lessen the 15% increase in premiums, there's a list of possible changes that could be made that could help to lessen that increase, whether that is changing the current deductible, whether that is increasing co-pays, whether that's increasing prescription co-pays. Those are some things that could be done to tweak the current plan that could reduce that increase. There's also one other item in here which has to do with what is called the family savings plan. And the family savings plan, the information is there, but if that was something that the county wanted to pursue and enact, that could possibly reduce the premium increase by 8.8%. That's the estimated decrease of what would be the increase in premium, so by over half. So we'll have more discussion about that in September as well. Finally, the other information that was there had to do with the state plan, because I have had some employees ask about just having the county go on the state plan. And my recommendation is for right now for this committee is to not make a decision for 2022 to go on to the state plan. Part of the reason why is because if we were to do so, that's going to have a major change into how we would be doing our health insurance. One of the big things is we would more than likely have 1 in 4 of our members out of network, so they'd have to find something new to be part of the state plan, because right now we are a PPO as opposed to an HMO. So, yeah,
Is that the ETF?
Yes.
The ETF is the state plan.
correct. And so the reason that I wouldn't want us to do anything for 2022 for this year, for next year, is we really haven't discussed it as to what are all the things that would happen there. And so what I would suggest to the committee is we still look at it, but we look at it in 2022 to determine whether we want to do something in 2023. That gives us more than enough time to talk about it, to possibly get input from employees, and then make a decision for 2023.
So without getting too deep into it.
Sure.
For time restriction, but just, I guess, generally speaking, we're looking at that 15% increase. You guys have been doing continuously evaluating rates, comparables and that sort of thing.
Correct.
And that they've been the most competitive. The state, yeah, as I understand it, that's gonna be possibly a hardship for some of our employees, being that they'd have to find someone in network. And have we typically taken the cost increase and put that back to the employees, or have we absorbed it at the county level?
We typically, sorry, go ahead.
It's
Paul.
shared.
It's shared in the respect that, again, we do an 85-15. The county, the employees pay 15% premium, we pay 85. So what happens, so whatever the increase is, the county pays 85% of that increase, the employees pay 15% of that increase. So in that respect, it's shared, but
Okay, that's
it's
fair enough.
it's proportionally the same.
Yep.
Yes, Doug,
In that option sheet, these are tweaks we could make to the existing plan.
correct.
Could you cherry pick of those enough to meet? Or maybe a combination of those plus the family savings plan? Can you hit the 15%?
Yes, you could, but again, that has some ramifications as well. The perfect example that I could give is that you could do the family savings plan, which is 8.8% estimated, and you could move the deductible from what is currently a $750 to a $1,500. In other words, right now it's the deductible is $750 single, $1,500 family in network. And out of network, it's $1,500, $3,000. Well, what you do then is, if you wanted to, you could say, no, now the in network is $1,500, $3,000, and that would be another 8.28%. So you would wipe out the entire increase. But what that has now done is that has increased the cost also now onto the employees as well. And so
It doesn't sound proportionate to me.
well, and so that's that whole, how do you balance that? Because with some, $750 is a very attractive deductible. If you look in other places, it's higher.
Well,
But then you
optically
look-
looking at twice as much,
Right.
isn't gonna sit well, I wouldn't think. with most
Correct.
people.
Exactly. So then how do you go about doing that? And to a certain degree, to us, to expect there not to be an increase, I think is a little naive, that only because health costs continue to go up. But what is considered a acceptable increase? And then last but not least, which is again the difficult part, is when we look at our spend, where's the money going? And for right now, the large amount of spend is going onto those large claimants. But that's part of the reason why we have insurance. So you could do something, but then it's hurting those people that need it the most. And so again, how do you balance that? And I think that's a good discussion that we can have with Horton in September and kind of go from there. Yeah, no,
What was the very last page with these different, the private health plans, I guess, Dean,
yeah.
Robin?
So what would happen is if you're going on the state plan, those are kind of the HMOs to choose from within the state plan.
Oh, those are state plans.
Those are
Okay,
state plans that those HMOs have a contract or an agreement with ETF to provide. And again,
They're the administrators.
right, and the other thing that we haven't discussed is, again, we are a PPO, which means pretty much people can go almost anywhere, right? If you really want to reduce, you could do an HMO, but then what that's doing is that's restricting where employees can go. And you wouldn't necessarily have to go through the state plan to do an HMO. You could do an HMO with Prevea. You could do an HMO with Aurora or with Bellin and negotiate that just individually with them. But again, for those people that are used to going to someone outside of those networks, they would now have to either come in network or pay higher costs, whether through premium or otherwise. I mean, deductible, not premium, I apologize.
I think just my opinion is if, this is a lot of numbers we'll have to talk over and everything next month, but anything that's gonna appear that we're taking something away, which
Correct.
would be going to an HMO
Correct?
and doubling their deductibles, I think would be the biggest thing. The biggest challenge is we gotta try to overcome.
Right, and,
But
but
yet
then,
we can't just pay for it and absorb it all
right,
either.
and that's the other difficult part is if we don't make changes, then, okay, the employee, not just the county, but the employee has that 15% increase as well on the premium that they're now paying. And so now when does that now become unaffordable for that family to pay that premium? And how many then start to opt out of the county health plan itself? So it's not easy. It's that balancing act that becomes difficult.
Right.
What percentage of the total employees have opted out of the county health
I forget what we're at. We're at close to 100 folks that are in, I believe,
plan? Okay,
employees wise, out of
150?
roughly 145.
But that's employees, how many does that encompass them when you include?
If you include spouses and everyone else, I thought we were close to 400.
So
Because that would
two-thirds
include
are in.
retirees and everyone else. Retirees are also on our plan until they're
They
65.
can be, not all of
Right.
them are on our plan.
Right,
So of that 100, some of those are retirees.
some, not many, but some. So again, this was more, again, not action, but I guess I'd much rather at the start give you information. Plus, if there's specific questions that you have, I can start to forward those to Horton. So that way, when we meet again in September, you have some of those answers. And what I will do is if you ask the question, I'll try to get the answer from Horton, and then I will share it with the entire committee. So that way, if you had a similar question or the like, everyone's singing from the same hymn. That was for you, Mr. Chair.
He was sleeping in the back. Too.
Sorry, I was thinking about donuts.
So. I can go to such other matters as prescribed by law. I was surprised I'd be here, but I was given actually a clean bill of health from Cindy, so that's all nice and good. But I spent most of the afternoon putting together the application, the federal application with Charter it's the NTIA broadband grant, which was due today. So that has been submitted and received. As for exactly when we'll know if we've been awarded, that I'm unsure of. But if we were to receive that award again, that would help to pay for broadband to the premises, to the home in all unserved areas in Kewaunee County.
Most
All unserved. They said all, but we'll see. You're right. You can't always go with 100%, but unserved areas.
They gonna get that before book Hustle gets up and running?
Who knows? And I mean, again, with my conversations with Steve, he's not worried. Why? Because he believes that he can be competitive on price in the rural areas, because what you may get from Charter, because it's fiber to the home, may be a little bit more expensive than if you're gonna go wireless.
Do you know of anybody that has service with Oak Hustle yet? I mean, actually up running?
No, I do not.
I believe they're getting close though. Because the first payment is due and they said, yeah, I know, but
I've been hearing that for 3 months.
Well, that's why I said the end of August.
Far away.
No, it's not.
When do we have to have a final decision on insurance?
I hope to have, well, we have in the budget 15%, correct? So we already have in the budget 15%. What we typically do is I like to try to get it done by September. So that way that gives all of September and October to iron out all the wrinkles. Why? Because in November is open enrollment for
Okay.
2023. So could we even wait till October? We could. It makes it a little bit more of a rush on Peggy's part in our office, but we can go as late as October.
Well, let's talk about it then in terms of finance committee meetings. Are we saying the beginning of October, we have to make a final decision?
I prefer if possible, even in September. If that means having a second meeting in
That's only 2
September.
weeks from now.
Right, if it means a second meeting into September, I'm fine with that as well. Only
It
because,
just seems like a lot of
I
information
was
to
wondering the same
digest.
thing.
and I'm fine with
I
that.
would say October sounds a lot more reasonable.
Well, and honestly, I don't mind having, because health insurance is a big thing. I don't mind, as long as the committee doesn't mind, having another meeting in September. That's not a problem.
Couldn't we just do it before the board meeting again?
Yeah,
I mean, as opposed to a separate day, I mean,
But that will be the decision day.
theoretically.
Does it have to
theoretically,
go before the board, or is it just a decision?
yes. Finance committee has the authority to approve the plan, and then it's
It's
the
in the
premium.
budget.
And because what you're basically doing is you approve the plan, you recommend what the premiums are, and the premiums are kind of hooked into the budget. So when you approve it that way, yes, the county board is approving what the premiums.
But they could cherry pick that outside of interrupt, but they could cherry pick out health insurance.
They could, but I think it would be very disadvantageous for the county board to try to be figuring out premiums and health plans with very limited knowledge, because that's not what their authority, that's not what their purpose is. That's the purpose of the finance committee.
Is it the October meeting we approve the budget, or November?
November,
November, okay,
the
so
first week in November.
we make a decision, county board meeting in October. Then the budget could be updated.
Correct. What happens is, at the September meeting, I present the administrator's budget to the county board. From that point on, at the October meeting, there is a public hearing. Anytime between that September meeting and final approval in November, the executive committee can make some changes having to do with wages and staffing levels. The finance committee can make any changes regarding any type of financial departmental budgets and those types of things. And then the county board at any of their meetings can make changes as well.
Yep, okay.
So that's all I have, Mr. Chair.
All right. Next meeting is our next meeting in September.
Yeah, that's September 2nd, is it?
Yes.
You need a motion to adjourn, Mr. Chair.
We need a motion to adjourn. Anybody want to do that?
Take a motion to adjourn.
Second.
Seconded by Jeff. All those in favor, signify by saying aye.
Aye.
Opposed?
You know how to get out, right? Yes or no? Okay.